Hello everyone and welcome to Investment News TV. My name is James Burton and I am here in Denver at the Schwab Impact 2025. Delighted to welcome Mike Graziano here from Partners Capital, product specialist, I believe.
Yeah.
Welcome to the show.
Thank you. Appreciate it.
Now, evergreen private equity. Yeah. Tell me a bit more about it, a bit more about what you're doing in that space.
Sure. So evergreen private equity, I would say, is the latest trend in the fund space. And so what you've seen over the years in the institutional market is an institution will go out, invest into a fund. They draw capital over 4 to 5 years. It takes time. It's a closed-end vehicle, and then you eventually get your capital back, hopefully, in another 4 to 5 years time. And so that can be very taxing, very complex, very tough to underwrite, and ultimately difficult for, I would say, wealth investors to put capital and believe in.
Yeah.
And so the trend now, what we're seeing really is these concepts called evergreen funds. Evergreen funds are investing in the same underlying portfolio companies, right? But they're perpetual, they're semi-liquid. You can go in every month if you would like to. Some are allowed to invest in every single day, and you can ultimately get liquidity from them. So it's an easier, simplified way to invest in an adjacent institutional solution that, many endowments and foundations and scaled portfolios, that's how they invest today.
So how would you get your returns? How does that work?
Yeah, I mean, the idea is really, if you're an investor, right, and you want to have an allocation to private equity, you believe in it, understand the concept that there's, a significant amount of private companies. The trend is sort of here to stay, of companies staying private for longer. You get your returns from the appreciation of the fund. So in the vehicle, capital will ultimately be realized. These underlying deals will be eventually, redeemed and sold. And so the manager of that evergreen vehicle will reinvest the proceeds. And so that fund will ultimately grow over the life versus you having to think about, reinvesting your capital into new opportunities. The manager does it all for you at scale.
And public versus private, that whole debate, I mean, what's the attraction? Is it chance for more returns? Is that like a big thing?
Yeah, it is. I mean, it's definitely more returns, right? So if you go back and you look at historical returns over time, you will see that depending on what index you look at, private equity has outperformed public equities. The last 10 years, last decade has been a different story, right? You've seen some of these big mega cap names really grow and drive a lot of the value in the S&P 500 and some of these other indices. And so I think personally, private equity is here to stay. You would want to invest in this ultimately to earn excess return above public markets, which I think will happen over time as we start to normalize. The second point I would say is it's just less reliance on driving factors from public markets, right? Public markets have rallied because interest rates have been low, right? Multiples have expanded. And so when you start to go down market into these, stronger cash flowing companies, you can generate returns and grow these companies in a different magnitude away from just multiple expansion that you can't control.
I'm just playing devil's advocate here. What about the risks? And, if the S&P is doing fine, I just stick it all in a ETF, set it, forget it, and go enjoy my life. What is it that you think positions you as like a bit more compelling than that?
Yeah, I mean, I think the biggest risks are illiquidity, right? So if you invest in private equity, you're locked up. There is no market. So if you need cash, you can't sell your instrument, right? Whereas if you own the stock in the S&P 500 or an index fund, you can get out day one. Evergreen kind of solves this feedback loop where you can provide liquidity at certain intervals, right? And ultimately, try to match what an investor wants, right? But yeah, illiquidity, I would say, is the biggest risk more than anything. There's some more complicated stuff we can go down the rabbit hole of, but illiquidity is the biggest risk. And, I think there's a little bit of an opportunity there to simplify and make that a little bit more compelling for, advisor or someone who's not as familiar in the private markets.
All right. Well, thanks for sharing your thoughts, Mike, and coming by.
Appreciate it.
I appreciate it. All right. Thanks very much to Mike again, and see you next time on Investment News TV.